And then I think Bitcoin's going to do even better still. The chart that Mike showed where the Bitcoin being right up against the increasing trend line, Bitcoin to gold, I think right now the easier trade is to buy Bitcoin than to buy gold. Gold's had a nice run. Bitcoin has lagged to that. Bitcoin will follow, in my opinion, and it'll follow with a vengeance. I mean, I think we'll be at 150 by year end and 250 sometime next year. I mean, I know Powell, for example, would have definitely liked to have been steady on rates or raised them so that he could maintain his Volcker reputation. Even he said, and he admitted the risks to both sides were quite high and they hadn't attained their inflation mandate, but he said he was worried about the employment side, and that's why he cut 25 bips. So here we are, but I remain a raging bull on gold, silver, and Bitcoin.
Lawrence Lepard says gold and silver are both headed much higher. It's not a question of if but when. But out of the three, he's most excited about Bitcoin. The Bitcoin to gold ratio chart he points out is sitting right on a major uptrend line that's held for years. Gold has already had its run, while Bitcoin's been consolidating. To him, that's the setup for a breakout. His target $150,000 by the end of this year and $250,000 sometime next year. That said, Lepard admits he misjudged one thing: the stock market. He expected a sharp correction, calling it a bubble inflated by easy money, but the bubble hasn't popped yet. Corporate profits and valuations have both hit record highs compared to GDP. The entire system, he says, is being propped up by excess liquidity flowing into financial assets instead of the real economy. Meanwhile, government deficits are ballooning. Tax receipts look stable only because stocks are high. If markets stumble, revenue falls and the deficit blows out even further. Underneath the cracks are already forming. Credit card and auto loan delinquencies are climbing, growth is slowing, and Powell's recent rate cut shows even the Fed is nervous about the job market. Despite the distortions, Lepard's view stays the same. When reality catches up to the debt, the printing presses come back on, and when that happens, gold, silver, and Bitcoin are the only assets that'll keep their value. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
To me, what's going to happen in the gold and silver markets is kind of a pretty easy call, kind of a no-brainer almost. They're going to go higher over the next several years, undoubtedly. And then I think Bitcoin's going to do even better still. The chart that Mike showed where the Bitcoin being right up against the increasing trend line, Bitcoin to gold, I think right now the easier trade is to buy Bitcoin than to buy gold. Gold's had a nice run. Bitcoin has lagged to that. Bitcoin will follow, in my opinion, and it'll follow with a vengeance. I mean, I think we'll be at 150 by year end and 250 sometime next year. I'm quite bullish on both of these, both of these assets as against fiat. Where I'm a little less certain, and I've been dead ass wrong, and I don't know, Carl Lary and some other guys took me to task for it on Twitter, which kind of pissed me off. But I've always thought the stock market was a bubble and was going to be going lower, and I've been dead ass wrong on that. They've managed to keep the stock market inflated despite being at record high valuations by every single metric. And
nope, not every.
Close to them all, Dave. Close to them.
I mean, corporate profits are as bubbly as market cap. Market cap to GDP and corporate profits to GDP are the same chart. That's the difference.
Right, but they're both at record highs, as I recall.
They are absolutely 100%. But the point is that there are dynamics going in here. Some of that sloshing money is more money is moving into financialization of financial products than people want, and it's causing all sorts of interesting pathology.
And I mean, here we are, we're running these record deficits, and we've got a healthy stock market, so tax receipts from stocks are where they should be, according to the government. Well, what happens if and when that changes? Because we know in the last two big stock market declines, social costs go up, tax receipts go down, deficits blow out. We're running a record deficit percentage of GDP right now, or close to it, other than the two big prints. And we're starting to see cracks. Tricolor's a crack, First Brands is a crack. This Argentina thing is a big deal, right? I mean, we don't have money for lots of things, but we can print 20 billion pesos to, to keep Argentina out of China's hands. So, we're starting to see, and the data on, consumer delinquencies in cars and consumer delinquencies on credit cards is getting worse. Not terrible yet. But there's some signs that maybe the economy is getting to be punk. I I know Powell, for example, would have definitely liked to have been steady on rates or raised them so that he could maintain his Volcker reputation. Even he said, and he admitted the risks to both sides were quite high and they hadn't attained their inflation mandate. But he even he said he was worried about the employment side, and that's why he cut 25 bips. So here we are, but I remain a raging bull on gold, silver, and Bitcoin. I think they're really the only way to protect yourself against what Dave describes as an increasing denominator, or I described in my book as the big print, which is kind of in the process of happening, but it hasn't gotten really big yet, but it might. So we'll see.
Mike McGlone believes the recent market dip isn't just a blip, it's the start of a larger downturn. He points out that volatility measured by the VIX and 90-day S&P data recently hit 5-year lows. When markets get that calm, they rarely stay that way. All it takes is a spark like a political comment or an unexpected economic jolt for volatility to surge again. In his view, that shift has already begun. His charts tell a clear story. Gold priced in Bitcoin has broken below support that's held since 2022, a sign of changing market dynamics. The S&P 500 measured in gold looks like it's losing momentum and could be heading toward levels not seen since 2020. Meanwhile, bonds once thought to have bottomed are climbing again, suggesting deflationary pressure is creeping back into the system. McGlone admits he misread long-term bonds earlier this year, but now he expects them to outperform stocks as speculative risk unwinds. Rising volatility, stretched valuations, and weakness in assets like MicroStrategy, often seen as a proxy for Bitcoin, add to his case that the cycle has turned. To him, markets are shifting from complacency to caution, and the era of easy gains is likely over. Let's get back to the interview.
The key question now as we enter the beginning of 4Q, is this the beginning? Is this the end of just a little bit of liquidation, or is this the beginning? Obviously, my bias, it's the beginning. I'd like to show a few charts why. So first of all, Trump made those comments, but we know the number one thing that emboldens this president is the stock market, and that was proven by his 90-day delay back in April on the tariff. So what I show you here, this is 90-day volatility on the S&P 500, and it just bottomed from the lowest level in 5 years. Wow. And the same chart is the 200-day moving average of the VIX. You know, those of us who are technicians call that's a bull flag. It went up, it's staying there. Now the VIX is above that level right now, 19.3. So this is just little normalization. You get that 90-day volatility towards the same levels of VIX, which is about its average. VIX is usually trades at a premium. That's going to happen. It's just a question of when. I think it's happening now and sooner, and I'll point out some of the key things that really trigger me. Here's gold in terms of Bitcoin, the gold ounces. It's broken below this key support that's held since the bottom 2022. Now I show a weekly chart and also show the S&P 500 in terms of ounces of gold. It's breaking down. Looks like it's going to break below that low from 2020 at 1.5. And again, there's a good reason. Volatility is so low. When volatility gets this low, he just needs a little trigger. And Trump saying anything can be the trigger. I'll say here's a key leading indicator. Strategy. Those of us who invested in this thing in the past, it's broken down. Strategy is below its 200-day moving average. It's showing resistance and breaking down at the same time. Dave mentioned earlier T-bond prices. Again, this is where I started in the trading pits. What I know the most, I thought had bottomed back here. It's just starting to show life to start rallying. That's deflationary forces as we get the deflation from cryptos. And I want to show you one thing that Scott's know I've been wronging for quite a while. I'm just showing you this is the total return of the S&P 500 this year. Peaked up around 17. It's heading lower as volatility is bottoming. Now it's around 12%. And this is the total return of TLT, the most widely traded long bond contract in the world. I've been completely wrong in this. I think they're going to cross paths, and TLT is going to outperform the stock market this year. And one key reason is because volatility is just so low. There's so much speculative excesses, and cryptos are the leading top of that whole thing. And this is why I just look at this little chart from MicroStrategy. If it's going down, it's just a signal the whole space is just due for some mean reversion. What we saw this weekend is what you typically expect. So what do we do going forward? And that's why I think you're supposed to be looking to sell rallies in all risk assets. Even gold is pretty expensive at $4,000 an ounce, and silver above 50. It's not a place you want to go out and buy. Lessons have been taught by buying silver above 50. Sure, maybe it goes to 55, but you don't want to buy into when you have short covering or squeezes like this. This is when you're supposed to say thank you very much. And here's what I like to end with: is it's really hard picking bubbles, shorting into bubbles, using derivatives. Now I did that well in 2008, but because I had a rough year in 2007. What's been easy this year is being long gold, but now that's expensive. So what's the next big trade? And that's why I just look at that volatility. This volatility continues to just recover a little bit from a 5-year low. that's an awesome trade, but for buy and hold people, it's going to be tough.
Momentum in financial markets is starting to look more like a pressure gauge than a compass. Everywhere you look, the signals are mixed, stocks still hovering near record highs. Yet beneath the surface, leverage, debt, and liquidity risks are quietly multiplying. Gold and silver remain steady in their role as monetary anchors, but Bitcoin is increasingly acting like the speculative lightning rod that reflects confidence or fear faster than anything else. When liquidity floods the system, it rises first. When that tide turns, it falls the hardest. What's happening now feels like the setup before a major repricing event, where illusions of endless growth collide with the limits of real purchasing power. Deficits, rate cuts, and slowing demand are all symptoms of a system that's been stretched too far by cheap money and delayed consequences. Whether the next move is an inflationary surge or a deflationary unwind, the shift will test everything from investor conviction to policy credibility. And as traditional safety nets begin to fray, it raises a larger question: when the next financial reality check arrives, will the world turn to paper assets for shelter or finally seek refuge in hard money and digital scarcity? So stay tuned. If you're into real data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.